Here's something most people in finance won't tell you. The more financial news you consume, the worse your investing decisions probably are. Think about it. On any given week, you've got CNBC telling you a recession is coming. X has some guy with 400,000 followers saying a penny stock is the next Apple. An analyst on Bloomberg just downgraded a company you've held for 3 years. And somewhere in your newsfeed, there's a Reddit thread that went viral about a meme stock moving 40% in a day. So you panic, you sell, you chase, you buy at the top, and then you wonder why your portfolio isn't growing. That's not an investing problem. That's a noise problem. Welcome to Clear Market, where we cut through the noise and focus on what actually matters, the business behind the stock. I'm glad you're here. Let's get into it. So what exactly is market noise? Market noise is anything that makes you feel like you need to do something with your portfolio right now, without any real analysis behind it. It's the daily price swings that mean almost nothing long term. It's the Fed announcement that sent the market down 2% on a Tuesday. It's the earnings beat that somehow made a stock drop anyway. It's the analyst upgrade that bumped a stock 8% in a morning. It's the meme stock that went viral on Reddit and hit headlines on CNN. None of it tells you whether a company is actually worth owning. Real investing is slow, it's boring, and that's exactly what makes it work. The investors who consistently do well, they're not watching tickers all day, they're reading income statements. The income statement is one of 3 core financial documents every public company in the United States is required to file. It shows you in plain numbers whether a company is actually making money and how. You don't need an accounting degree to read one. You need about 10 minutes in the right framework. This is the 5-step process I use, and after this video, you can use it too. Step 1. Understand what the business actually does. Before you look at a single number, ask yourself, can I explain this company in one sentence? If you can't, don't invest in it yet. Warren Buffett has said this for decades, and it still holds. Knowing the business tells you what the numbers are supposed to look like. A retail company should have high revenue and thin margins. A software company should have lower costs and higher margins. Context matters. Step 2. Know exactly how the company makes money. This is different from knowing what the business does. A company might sell shoes, but does it make money from direct sales, wholesale, or subscriptions? Does it rely on one big customer? Does it operate internationally? Look at the revenue breakdown section of the income statement or the earnings report footnotes. Follow the money. Step 3. Check revenue and earnings growth. Over time, not just one quarter. Here's where most beginners go wrong. They look at one quarter's numbers and make a judgment. That's like reading one page of a book and deciding you know the whole story. What you want to see is a trend, ideally 3 to 5 years of data. Is revenue growing year over year? Is net income, that's the bottom line, what's left after, all expenses growing alongside it? If revenue is climbing but earnings are shrinking, something's off. Maybe costs are rising faster than sales. That's a red flag, worth investigating. Step 4. Review debt and cash flow. The income statement shows profit, but profit isn't cash. A company can look profitable on paper and still be burning through money. Check 2 things. Operating cash flow, is the core business generating real cash, and long-term debt. How much does this company owe, and can it handle it? A company drowning in debt has very little room to survive a downturn, no matter how good its headline earnings look. Step 5. Compare the stock price with the business value. This is where valuation comes in, and you don't have to get fancy. Look at the PE ratio, price to earnings. It tells you how much you're paying for each dollar of profit. A PE of 15 means you're paying $15 for every $1 of annual earnings. Higher PE can be justified for fast-growing companies, but not always. Ask yourself, at this price, am I paying a fair price for what this business is actually producing? If the answer is yes, you're thinking like an investor. If the answer is, I don't know, but the chart looks good, go back to step 1. Let's make this real with a simple example. Imagine a company called Maple Retail Co., a fictional mid-size American home goods chain. Step 1, they sell kitchen and home decor products across 200 stores in the US. Step 2, roughly 70% of revenue comes from in-store sales, 30% from their online store, which has been growing. Step 3, revenue has grown 8% year over year for the past 3 years. Net income has grown 11%. Margins are expanding. That's a green flag. Step 4, long-term debt is manageable, about 1x annual operating income. Operating cash flow is strong and consistent. Step 5, the stock trades at a PE of 18. For a stable, growing retail business, that's reasonable, not cheap, not overpriced. No hype, no analyst rating, no Reddit thread, just the numbers, telling a clear story. Before we wrap, let me quickly flag the mistakes I see beginner investors make most often. Mistake 1, looking at one quarter in isolation instead of a multi-year trend. Mistake 2, confusing revenue growth with profitability. Growing sales don't always mean a healthy business. Mistake 3, ignoring debt because earnings look great. That's how people get caught off guard. Mistake 4, letting the stock price movement drive the analysis. The price is not the business. Here's a simple weekly routine that takes less time than scrolling social media. Monday, ignore the market open. Don't check prices midweek. If one of your holdings released earnings, spend 20 minutes reading the income statement, not the headlines about it. Weekend, pick one new company. Run through the 5 steps, just to practice. That's it. Slow and deliberate beats, fast and reactive every time. Quick note, everything in this video is for educational purposes only. Nothing here is financial advice, and I'm not your financial advisor. Always do your own research before making any investment decisions, and consider speaking with a licensed professional if you need personalized guidance. The market will always be loud. Your job is to stay quiet and read the numbers. Now I want to hear from you. Which US stock do you want me to walk through next? Drop it in the comments below. If I get enough votes for one ticker, that's our next video. And if you found this useful, subscribe to Clear Market. No hype, no hot takes, just clear analysis every week. See you next time.